Hello and welcome to this special interaction with none other than Ridham Desai of Morgan Stanley. They have their annual conference, and at the sidelines of the conference, Ridham Desai has decided to speak to us. Ridham, thank you so much for taking out time for us. Could you just talk to us about this annual event that you have? How is it different from last year in terms of perception about India? The key questions that were being asked last time around, we were in a bull run that, nobody was thinking would end. How is it different this time?
Hey, thank you, Pankaj, for having me over. This is again a virtual event for us. We debated physical versus virtual, and then we had to take that decision about 2 months ago, and it was not very clear whether we could conduct a physical event. So hopefully next year, that'll be our 25th year, and we'll be back in a physical format. Well, the interest in India continues to be pretty high. Notwithstanding what's happening in the markets. Remember, while we see the absolute foreign selling in India, it's not restricted to India. Foreign selling has happened across the EM cohort. The only country in the EM cohort that foreign investors have been buying over the past 12 months is China. And that's not really worked out well for foreign investors because I think 12 months ago when they were doing this switch, or when they were trading into China and trading out of, say, India and Korea, they were looking at relative valuations which looked very attractive in favor of China. The valuations continue to look that attractive. In fact, if anything, they've become even more attractive because China has underperformed. So that valuation trade has not clearly worked. India has actually done very well. In fact, until the beginning of May, India was up 900 basis points relative to EM only this year. Forget about last year when it had chalked up a 30 percentage point outperformance. Out of the 900 basis points, it's given up 600 basis points since the off-meeting rate hike by the RBI. Clearly that the market is digesting the shift in interest rates, but it continues to do well on a relative basis. And while it may seem back home that the bull market has ended, the fact is that on a relative basis, India continues to be in a soaring bull market. The absolute case for India, remains very strong. We are in the midst of a new growth cycle. You can see that in the earnings. They have been very strong for the quarter that just ended. We had 20% plus profit growth across almost any cohort in the market that you see: aggregate, Sensex, Nifty, broad market, 1,000 companies. So everybody is actually growing their earnings quite strongly. Yes, there are margin pressures that have emerged, and we do worry about them. The earnings growth in the coming 12 months is likely to be materially slower than the previous 12 months. The base effect will come in, and also there is some margin pressure. But the headline growth number remains strong, even though we've seen pretty persistent inflation for the past 4 or 5 months. Whether that filters into growth or not will have to be seen. But the key risk for growth is actually not at home. It's coming from outside India. It's coming in the form of the effects of the war. It's coming in the form of a slowdown in US growth. You can see export growth has slowed down visibly. So I characterize this as a correction in a long-term bull market, a pretty good correction in a long-term bull market, and all bull markets bring such corrections. You can remember 04 and 06 in the 03, 08 markets. Those corrections were quite punitive. Markets went down between 20 and 30%. We've still not had that type of a fall in absolute terms. But our US strategist is quite concerned about where the SPX is. He thinks the SPX could be at 3,500 in the coming months, in fact coming 3 months. And if that happens, then the Nifty may not have seen its absolute trough, even though on a relative basis, I think India will probably continue to do quite okay.
Hi, Ridham Desai. This is Nantara Rai also joining in on the conversation. You just talked about 03 and 08. Now, what we've seen is the sell button by the FIIs, the velocity, far more than what we saw after the great financial crisis. If you look at from October to May, exit of 3.36 lakh crore rupees. Can I understand from you, A, why this fear selling, which now has tempered down, And is this something we should continue to expect, given that China is reopening? There are a bunch of foreign brokerage firms that are now talking about reallocating funds also for China. So is that something that we need to keep bracing ourselves? And how the finance minister says domestic investors will continue to be the shock absorbers?
See, Nayantara, the first thing is that somebody has to sell. You can't have a market where everybody's buying, right? A trade is only created when there is a buyer and a seller. So the fact is, if domestic investors are buying the way they are buying, who's going to sell to them? Controlling stakeholders are not selling. So foreigners, there are only three cohorts in the market. There are foreign investors, there are domestic investors, and controlling stakeholders, whom we call promoters. So let's get that out of the way. Somebody has to sell to create a trade and to create a price and to have a market. The second thing, as I said at the outset, there has been a switch trade that foreigners made, which has not quite worked in their favor. But the fact is that India's relative position in portfolios has not gone down materially. It has moved by 20, 30 basis points. So foreigners remain overweight India. There has been large selling in emerging markets. So a lot of this selling is to do with the outflows that EM funds have experienced. Even though within that, maybe there has been some more selling because foreign investors have chosen to increase their overweight on China and decrease it ever so slightly on India, not by a whole lot. The third thing is, don't forget that since the pandemic, India's weight in the index has gone from around 8% to close to 13%. That's a massive increase in India's weight. That has happened in large part because India has done so well against emerging markets. Now, if you were holding India in your portfolio and you were, say, overweight 200 basis points, so you had 10% of your portfolio in India, if you did nothing, you would hold 1/6 of your portfolio now, 15% on India. And portfolio management requires you to actually alter that in case you don't want to have such concentrated exposure. So, part of the selling may have to do with that. The fourth reason is, the fact that a lot of the selling has been concentrated in financials. So if you see within the foreign investor portfolio, financials have had a disproportionately large share of holdings, almost 40% prior to the beginning of this selling. And it wasn't a sector that was doing so well. So there has been, a kind of a lowering of weight over there, and it has not been compensated by increase in weight elsewhere as yet. So that could also explain why foreigners are selling. So there are many reasons why foreign investors could be selling. Some of them, in fact, very few of them are specific to India. Most of them are actually emerging market related. The whole emerging market trade has evolved over the last 15, 20 years. It's not the same trade as it used to be. At the start of the 03-08 cycle, emerging markets were poised to do the best because they had the biggest benefit from rising global growth tailwinds. As a cohort now, that is no longer the case. A lot of emerging markets don't have the balance sheets, don't have the macro story as they used to have 20 years ago. A lot of them are broken now. India is an outstanding, different, very, very strong emerging market in the context. I dare say, it is not even right to describe that as an emerging market in the context of what its peer group is. But of course, it remains emerging because we're still very poor as a country. We are still at $2,000 per capita income. So technically, we're still an emerging market. But in terms of the growth prospects that we are offering, in terms of the size of our markets, in terms of the companies that we have, it is a class apart. So I think foreign investors may come around, but when that happens, you should be prepared to see domestic selling because everybody can't buy at the same time.
Absolutely. You've talked about the growth or the multi-year growth in the profit cycle, but a lot of commodity prices have gone up massively, which is raw material. Crude has gone up massively. A lot of supply chain shocks have come in. Semiconductor issues have come in. How does that change that cycle or delay that particular profit cycle?
It doesn't change by that much, but of course, if I was expecting at the end of last year, I was expecting 20% growth for this fiscal year, that is fiscal 23. Now that expectation has been lowered to around 12%. So there will be some deferral of that growth. It spills over into F24. My exit F24 EPS is almost unchanged, but there is a shift in terms of where that growth will come. Instead of F23, it probably now comes in F24. Of course, this assumes that the effects of the war will wane in time. and that's something that we need to watch. The supply chain outages are not going to be permanent. They will come back, and in fact, when they come back, I think we'll see a significant bounce back in production. The demand, for example, and take the auto sector as an example, which has been bearing the brunt of the supply chain outages. The demand, underlying demand, is very strong. It's the companies are not able to supply enough because of the supply chain disruption. So when that goes away, there will be a pretty large pent-up demand that will need to be serviced. As we saw coming out of COVID, a lot of sectors that benefited were the ones that saw pent-up demand of the last 2 years come through, whether it's travel, leisure, entertainment. A lot of these sectors have seen significant return of demand. So I would expect the same for, say, autos, where there has been a supply chain problem. The effects of the war, of course, it's hard to predict what happens to that, but I hope that they wane going into 2023. If they don't, then I think we should be prepared for a pretty rough environment for stock markets. It's going to be very difficult to absorb those supply-related increase in prices of oil, fertilizer, sunflower seeds. These are very critical commodities for India. Will we absorbing them for the next 6-8 months? It'll be harder to absorb them for a longer time frame. It will call for more interest rate hikes and probably more slowdown in growth, which will be kind of a mini external shock of that's the variety of impact that may have on India.
Now, May was, of course, a very brutal month for the equity markets. Ridham Desai, on a lighter note, I don't know if you had to exercise more and meditate more through that brutal month. But as we move on from it, and time of recording this is on the day of the policy as well, you talked about how FIs really sold a lot when it comes to financials. They could also merit in the argument that it is financials and banks that could end up being the best performing sector this year. Banks' corporate balance sheet cleanup that we have seen, credit growth which is picking up. I see you folks are also overweight on that space.
Yes, Nantara, it's a sweet environment for banks. They have rising rates to help their margins. Credit costs have certainly peaked. They're falling. In fact, there could be write back of provisions as well. And they are taking that and investing in to grow their businesses. And of course, credit growth is also recovering. It's a lagged indicator of economic performance, so we should expect it to do even better in the months ahead. So it's a sweet environment. Banks, should do well in terms of earnings. Valuations look attractive, so we are very bullish on the sector. It's our top pick, and I think for the rest of this year as well as going into next year, banks should do quite well.
We can talk about various sectors and how things are moving in, but let's talk about the bigger theme. Whether you play domestics or you play export theme. I mean, earlier you were very bullish on exports and how export-led demand would do well. Would you now shift to domestic players? May not be FMCG, but various other, like the auto that you mentioned, banks that you mentioned, companies that are directly linked with domestic growth. Should that be the theme?
Yes, Pankaj, we've been focused on that for the past few months. I think domestic cyclicals look better placed. Again, I'll caveat this by saying that the effects of the war need to come off by the end of this year. Otherwise, growth will slow down meaningfully, and then things will be a little different into 2023. But I think for the ensuing months, we should see a pretty strong performance from domestic cyclicals, which include the banks, it includes consumer discretionary companies, and it includes the industrials. So these are the places where we are most bullish on. On the export front, generally speaking, we do not like the external-facing sectors. With the exception of technology, where we think that there is very strong underlying structural demand trends, which are not being affected actually even by what's happening right now. Of course, if there is a US recession, which is not our base case, but if there is one, then tech stocks may take a severe beating as we've seen in the past. But the underlying structural trends in software services is very strong. They are going through some margin pressures because of increasing wage costs, but I think it's more or less priced in. The stocks have been underperforming quite a lot this year, so a lot of that has been priced in.
Ridham Desai, I was going through a note that you had written in April, and I quote from it, where you write that we are size agnostic. The relative correction in the broader market versus the large caps is likely over. That was in April. We've had the brutal month of May. We've seen the underperformance of the broader markets as well. What are your views now?
Yeah, we have shifted our preference towards the broad markets. So we want to own small caps over large caps. So we were underweight small caps relative to large caps since October last year. We kind of went neutral in April, and then the underperformance in May, I think, sets us up for being bullish on small caps. It's a price related thing. And I think small caps look a lot more attractive now than they were looking for the past 7 months.
Right. Ridham, just wanted to understand about the issues that the markets need to grapple with over the next few months. And how would you look at it? Inflation pressure, interest rate hike, what's happening with supply chain? I think we've spoken about supply chain in a lot of detail. But what do you think about this whole interest rate, how equity markets would react to it, how various commodity markets would react to it if there is a recession? So do you think it's a space where a lot of unknowns, and that's the reason for this jitteriness of FIS selling?
No, the FI selling, I think I've described in great detail, Pankaj. It predates all the rate hikes. It goes back a whole year. There was no rate hike in play at that stage. So it's got very little to do what's happening to the rate cycle now. The rate cycle was bound to turn. We were expecting that to happen earlier. It's actually happened a little later than our earlier expectations. And rates need to go up to neutral territory, as the governor and the RBI are highlighting. We are still below the pre-pandemic rates. So, I think at the minimum, we will be slightly above pre-pandemic. We expect another 50 basis point rate hike in the August meeting, which should then, kind of reflect the fact that the underlying economy is in a whole lot better shape. The interest rates need to reflect that. If you keep rates too low relative to economic performance, then you invite the risk of persistent inflation, which will then slow down the economy more dramatically later on. So the fact is that real rates have been kept in negative territory all through the pandemic for reasons which are obvious. And now they need to become neutral, and that's what the RBI is guiding to. And I think that's the right policy. So we are expecting that to happen. Now, of course, there are some temporary inflation pressures that have emerged, again, due to external factors, as we've been talking about. And those will likely ebb, and that's, I think, the assumption we're all making. And when that happens, then the real underlying inflation will emerge from where we are in the economic cycle, which I think is a lot more modest compared to the headline inflation right now because of external factors.
It's all about the R's, isn't it? Not just Ridham Desai, but rates, recession, and the Russia-led war that we are seeing in Ukraine. Red flags for all of us in the concerning areas when it comes to the equity markets as well, making inflation red hot. Ridham Desai, it's always a pleasure talking to you. Thank you so much for joining us here today on ET Now to help us understand how to navigate the markets and, of course, to make volatility our best friend. Many thanks once again.
Thank you for hosting me. Thank you.
Thank you, Ridham.